Hey, how's it going? Bill Lethman here for Money Evolution. In this video, I'm going to be talking about 7 strategies that could potentially help you to lower your risk in retirement. And the way that I define risk in retirement is the risk or the probability or possibility of running out of money later in life, or the potential that you might at some point have to significantly change your retirement lifestyle, maybe because your retirement assets have gone lower than what you expected. And be sure to stick around all the way to the end of this video because I've got one more 8th bonus strategy that I think could really make a difference in helping you to lower that retirement risk. So let's jump right in. I'm going to go through this relatively quickly here. Again, I've got the 7 strategies plus the bonus, but number 1 is one that may seem a little bit obvious to many people, but it's paying off your debts. And I'm not just talking about credit card debts, and hopefully you're not going into retirement with a bunch of credit card debts, but auto loans. Really, ideally, you would want to go into retirement without any debt, and that includes your mortgage. And if you think about it like this, and the reason why I think this is a factor that can potentially lower your risk in retirement is, let's say you're paying $3,000 a month on your mortgage at $36,000 a year. Well, if you have that mortgage paid off by the time you retire, that's $36,000 that you don't have to take from some other part of your retirement portfolio. And that's going to really improve your cash flow in retirement. And really in retirement, it's cash flow that really is one of those most important factors there. Now I know what some of you may be thinking here, and maybe you've got a mortgage. Maybe you got it before the rates started going up here a few years ago, and you're at 3 or 3.5%, and you're saying, yeah, but Bill, I'm making 6 or 7% or whatever your assumed rate of return is on your portfolio. Aren't I better off to keep that debt and make that difference of the return? And while mathematically that may be something that seems to make sense on paper, there's of course no guarantee that that retirement portfolio, those assets are going to grow at that anticipated rate of return. In fact, actually we could have the opposite, and those assets could go down in value. So if your retirement assets that you're using to pay that mortgage go down by 10 or 20, or we have a major market correction like we had in the early 2000s where you see a 50% drop, well then now you've got a lot lower assets to try to make that cash flow to cover that mortgage. So paying off debt, I think, is a great strategy, and it's one that, because it improves the cash flow, I think is going to really have a big difference. Number 2 is going to be to delay taking Social Security. And if you've been following me, or you know about Social Security, you know you can collect Social Security as early as age 62, but it's going to be at a pretty significantly reduced amount compared to what it would be at your full retirement age, likely age 67. You also have the possibility of delaying your Social Security benefits all the way to age 70 to continue getting an 8% increase beyond full retirement age for every year that you delay to max that out at age 70. So as you're putting together your retirement plans and really mapping out your cash flow, you may have some bigger gaps in the early years by delaying that Social Security benefit, but the end result is going to be more cash flow, and your retirement gaps later in life and that predictability of income, I think, is going to be something that's going to make a big difference there. So delaying Social Security is number 2. Number 3 is going to be, get my pen straight here, is going to be a pension. And if you're lucky enough to have a pension, you may have some options on what you can do with that pension. You can take it on your life only. You can also tie it into your spouse, which we highly recommend, at least having some portion of that pension remaining for your spouse, even if it's 65% or 75% of the amount that you would get. Or you could go and be even more conservative and do the 100% surviving spouse option. But I also want you to think about this as well, because many people are really tempted to take that lump sum pension buyout. And we help clients with this all the time and really analyzing whether or not it makes sense to take the lump sum or to keep the monthly pension. But in terms of giving us more predictable income and really, I think, lowering the overall risk of retirement and the possibility of hopefully living longer and needing that money for longer, oftentimes keeping the monthly pension is something that's going to be a better option, or at least a safer option, because of that predictable income there. So number 3 is to generally think about keeping that monthly pension amount, or at least doing the right calculations to really understand what that trade-off is and how it fits into your cash flow. Number 4 is going to be, and I've talked about this in a recent live stream video that we did on annuities, but if you don't have a pension, and I've had a lot of clients come to us and say, hey, I really wish I had a pension, my parents had a pension, or my grandparents had a pension, and that predictable income was really nice. I'm not going to get into a whole lot of detail here, but at least to keep the option open or to explore the possibility of an annuity as sort of an alternative to a pension or as an alternative to some of the other investments that you might have in your portfolio. One of the things that annuity can do that many other investments can't do is give you that lifetime guaranteed income stream. Oftentimes, again, just like your pension, you might have the option to keep that pension for you or your spouse as long as either one of you are alive. So again, as you're going through your retirement planning and you're mapping out your cash flows and trying to fill in some of those gaps, considering having a part of your investment strategy in something like an annuity so that you have another source of predictable income and it takes pressure off of the other parts of the portfolio. Again, there's a lot more that goes into the decision to buy an annuity, but at least to keep that idea or option open for you. Number 5 is going to be to keep your withdrawals to 4% or less. Now, this is something that I've talked about a lot of times on the channel here. You've probably heard other people talk about it. It's something called the 4% rule. And it was created by somebody or came up, the idea was conceptualized by a guy named William Bengen in the early 90s, a certified financial planner. And he went through and did a lot of research and mathematics on what's called sequencing of returns. And so what that means is that even if you say, I'm retiring at age 60 and I'm going to have a diversified portfolio, I'm going to get a 6% or 7%. Maybe you're even thinking a higher rate of return depending on how you have the assets. Even if you get that higher average annual rate of return, that's an average. And just like any average, you're going to have some numbers that are going to be a lot higher and some numbers that are going to be a lot lower. So something called the sequencing of return, and in particular, if you get a bad sequence in the early part of your retirement, that may be something that is either very difficult to recover from or impossible to recover from. And that little gap that you develop early in retirement with those negative years, you might not be able to recover, even if the markets do above average later on in your lifetime. So if you limit your withdrawals to 4% or less, according to William Bengen and the followers of the 4% rule, and I think it's just a good rule of thumb, but there's a lot more that goes into this as well. But if you keep those retirement withdrawals to 4% or less, that's going to give you a better chance of not running out of money later on in life. Number 6 is using a bucket strategy. And this is something, again, I've talked about on the channel here. And what this basically means is that you're going to, number 1, understand what your retirement gaps are. So you're going to know how much money you're going to need to take out every year. That number is likely going to change a lot through retirement, especially if you retire early. You might have some bigger gaps in the early part of your retirement. Maybe then as you get Social Security, if you and your spouse are different ages, that age for collecting Social Security might be off by a couple of years. You may get yours and your spouse may have a couple more years before they're eligible to get their Social Security benefit or until their full retirement age. But you want to know what that gap is. And again, maybe bigger in the early years, maybe it starts to level off a little bit. And then another piece of this that's going to come into factor is going to be things like your required minimum distribution that are going to start, depending on your age, either 73 or 75 according to the new rules. But the idea of this is to use 3 separate buckets to basically create a little bit of a buffer so that if the market, or I should say when the market has its downturns, you've got some money in some safer investments that you can ride out some of those market downturns. And the way we tend to do this is bucket number 1 is going to be your safest bucket. And that's going to be very liquid, very safe investments. We're talking like FDIC insured money markets or short-term CDs, treasury bills, things like that are going to be very conservative, that are liquid, and that's going to cover your first 2 years of living expenses. The second bucket, still going to be very safe. We still want that to have mostly in fixed income types of investments and things, but it could be something like a CD ladder, some shorter term bonds, again, something that's going to be very conservative. And the idea is that you're going to keep 3 to 5 years of your cash flow in that second bucket. And hopefully there's going to be some interest, and some of that interest can go in and help you to refill or replenish bucket number 1. Bucket number 3 is going to be your growth bucket. And the design of that is primarily to keep up with inflation. And that's going to be where you're going to get some equity investments, some mutual funds that are going to be geared towards a little bit more growth. And again, this may vary a little bit depending on what your risk tolerance is. And even if you fill in those first 2 buckets, you may still want to have your third bucket, the growth bucket, a little bit more conservative if you're a little bit more risk averse. But the idea there is that you've got maybe, let's say, a 7 or 8 year window where if the market were to take a downturn, you could effectively deplete those first two buckets. And hopefully before buckets 1 and bucket 2 get to 0, you'll be able to have the market recover and you'll come back and fill those buckets up again. But the idea too, and I'm going to do another video where I talk all about how to manage this bucket strategy, but the idea is at least once a year, but more likely even 2 or 3 times a year, you're continuously taking money out of that growth bucket and replenishing bucket number 1 and bucket number 2, so that when the market downturn does come, you've got your buckets completely topped off, and it's going to give you that full window of maybe 7 or 8 years to ride through that market downturn there. Number 7 is going to be to diversify your portfolio. And this is obvious. This is actually Finance 101 or Investing 101, is to have investments in a lot of different areas. And this is going to be not just a difference between stocks and bonds, but also looking at the types of stocks that you own, looking at growth stocks and value stocks and large company stocks and small company stocks, and even really getting into, if you're buying mutual funds or ETFs, for example, getting into the individual positions within those different mutual funds. We were looking at a mutual fund. It was a growth fund company from one of the biggest investment companies in the country, and it might be seeming like, hey, that's a good diversified portfolio, but if you look at it, it had about 40% of the money in just 7 or 8 stocks, and it was the stocks that you'd probably expect. It was the Microsofts and the Google and the Amazon, Apple, Nvidia stock. If you followed that, that's been a really hot stock here over the last couple of years. In fact, actually, I think it had 16% of the entire portfolio in just Nvidia stock. And that may be something to look at and evaluate and say, hey, do I really want to have all this risk? But not only that, but you might say, hey, maybe that's a good thing for part of my portfolio. But you may find out that if you start looking at the 4 or 5 or maybe even 10 different mutual funds that you own, you may find that, hey, that Nvidia stock is a big position in all of these mutual funds. And again, just to kind of at least let yourself know what that is, and is that a risk that you're wanting to take. You can also look at other sort of non-correlated assets that you might want to add into the mix there, and there's a lot of different ways to do it. I'm not going to get into all the details there on what are considered non-correlated assets, but real estate might be one of those. In fact, actually, for some people, real estate might even be something outside of your investment portfolio with the paper assets. Some people are even inclined to buy rental properties, and that's a whole other deal. You're actually managing a business, and it should be treated like managing a business, and there's a lot of skill set that goes into managing that, and there's some time involved with it as well. But real estate is another thing, again, going back to predictable income. If you have good cash flow producing properties that have money coming in on a regular basis, that's something that can give you a little bit of diversification compared to what the stock market may offer there. So making sure you're diversified, knowing what you have in the portfolios, I think is a great way to stay diversified and spread that risk around a little bit. Okay, so let's get into our 8th one. And this is, I think, a big one. And it's a big part of what we do with our clients at Money Evolution, and it's really tax optimization and having a plan. Because as we're looking at this, you're going to likely go through several phases, especially go into retirement. You're going to have a tax situation maybe while you're still working. You're going to have a tax situation in the early part of your retirement. Something I've talked about in many other videos is this period of time at the beginning of your retirement, especially if you retire early, where maybe your Social Security hasn't kicked in and you have some low tax years. And there's going to be potentially some opportunity for doing some what I call tax arbitrage. In other words, maybe doing things like Roth conversions and taking money out of your retirement account either to fund some of your early retirement living expenses, or doing those Roth conversions if you don't need all of the money and shifting that over to a Roth IRA account. So what you're doing is you're filling up some of those tax brackets in those early years and taking advantage of those low tax years, so that later on, when you take money out and you're getting Social Security, you take money out of your retirement accounts, or you're forced to take money out at your RMD age, you're not going to be pushed up into a higher tax bracket there. So the working years, the early years, and then what I like to call, I always refer to it, the way Social Security refers to it, is your full retirement age. So at 67 for most people, your full retirement age for collecting Social Security, that's when income and expenses start to normalize a little bit, and understanding what that tax situation looks like there. And then also be thinking ahead all the way out to that RMD age, which again is going to be age 73 and 75. and looking at, okay, with the money that I have in my portfolio right now, with the growth and what I'm expected to take out over these first years of retirement, what does that retirement balance look like, and what could that potentially mean for my required minimum distribution? So this tax strategy really starts with where you're working, because when you're working, that's where you have the option of usually putting money into a Roth retirement account or a traditional retirement account. And the traditional, you're going to get some tax benefit early while you're working, but the Roth, you're not going to get that tax benefit while you're working, but you're going to get it later on. So when these IRA accounts first came out, the Roth didn't even exist for many of us. You know, when I first started, the Roth account didn't start. I think it came in the late 90s maybe, but we only could put money into the traditional. And the idea was always that we're going to take that tax deduction right now, so we don't have to pay taxes at the rate while we're working. Of course, we're going to be in a higher tax bracket while we're working, and then we'll pay taxes later when we're retired. We're not going to have our job income coming in anymore. So that seemed to make sense, but as people built up larger retirement portfolios, and then the tax rates since the early 90s have been on a steady decline. In fact, we've got some Tax Cuts and Jobs Act rates right now that are set to expire at the end of 2025, and they're set to sunset, and then we're going to revert back in 2026. However, we have a new political administration coming in just as we're filming this, a couple days actually, and that new administration has sort of pledged that they want to extend those tax cuts or maybe even go a little bit deeper. So we may see a continuation of these lower tax rates. So that's all things that go into this strategy. And even if we do get an extension of the tax cuts right now for a short period of time, because of the large deficits and the large government debt that's looming over and potentially paying that off, or at least keeping it from growing quite as much, is it going to be a potential time in the future when those tax rates might be higher? Those are all things that go into this. If you're filing a joint tax return, at some point you may, in retirement, have to expect that at some point you may go from a joint tax return to a single tax return. And what that means is that you're going to hit higher levels of taxation at lower levels of income. So putting that all together and planning it, I think, can really help a lot. And because we're actually saving money in taxes and kind of smoothing out these taxes over time, it actually does help to reduce the overall risk of the portfolio in many cases, because we're not getting hit so much with taxes over our lifetime, or at least in those big spikes that may happen down the road there. So anyway, 7 strategies plus the bonus on how you could potentially lower your risk in retirement. Hope you liked the video. If you do like the video, be sure to hit the like button, and if you haven't already subscribed to our YouTube channel, go ahead and hit that subscribe button. And if you'd like to learn more about what we do at Money Evolution, you can go to moneyevolution.com. Check out all the great resources over there. We're actually building out an entire financial education resource library covering all kinds of different financial planning, retirement planning, tax strategies, personal finance, all of that kind of in a easy to follow library where you can get access to all of that. So go ahead and check that out. We'll put some links down in the description below, and I'll look forward to seeing you back in one of our next videos. Thanks.